Are we ready? Senor?
Yeah, I'm ready, bro. Now you can think clear.
You got the juices flowing? You ain't sweating, dog. You're good, dog.
No, is that I've been, working out. Okay, let me talk a little bit. So, hey guys, it's Gusto Villalobos, Mr. J Lobos. I'm actually the president and CEO of Buildworth Strategies. We're actually a credit consumer advocate organization specializing in credit restoration, also credit education. We're actually located here in Miami, Florida, at 5911 Northwest 173rd Drive. And today, it's actually our first and foremost seminar that we wanted to go ahead and share, not only with the public, but also people who are looking to either better their financial situations, are looking to go ahead and maybe get into their first home, looking to maybe buy a second home, or even manage money. But we're also going to be talking about that important thing, which is obviously credit, right? So it's a credit, money, mortgage seminar. So we're going to be obviously featuring myself, also my friend Brent Bo, and obviously we have a special speaker talking about mortgages. It's a little bit about a lot of things, right? Nevertheless, we're going to give a lot of fruitful information with regards to how credit works, how to restore credit, also the rules and regulations, as well as how money works with regards to debt, assets, debt elimination strategies, investments, those type of things, and also special finance programs and that are obviously being offered right now through the mortgage industry. So stay tuned, check it out. I kind of like start off my presentations similar to the ones that I have in my office, really just thinking about what exactly I'm going to go ahead and talk about. First and foremost, I want to go ahead and give special recognition and attention to obviously the people that did make this happen. We also have Mr. Charles Woods from Focal Management, one of our sponsors. He's also a financial advisor and whatnot, and he's a business coach. We also have obviously Brent Bo, which is obviously part of the speakers that we have today. We also have Pedro Tabasco from Miami Express Auto Lease as well. He's also an auto broker. So in reality, guys, obviously I'm Gusto, the president and CEO of Buildworth Strategies. We're actually a credit repair organization where we specialize in credit restoration. So basically, I wanted to go ahead and talk about a few things today. One of the major things is obviously rules and regulations, what actually is credit, how does credit work, and a little bit about credit in general. And I don't know, I guess this is where my fear of speech came in. So just bear with me a little bit. Obviously, this is one of many. This is obviously something that we've been practicing, trying to get ourselves into this next step of evolution. We've actually grown as an organization. We've been able to help actually a little bit over 13,000 people over the U.S. We're actually we service the whole United States, all the way from Alaska to Puerto Rico. So we really don't have any kind of limits when it actually comes to servicing people. In reality, credit obviously is a formula, guys. So there's going to be rules and regulations that are going to go ahead and apply. So how is it, or what is the importance really of just having credit, or why is credit so important in reality? So those are actually one of the few things that I always think of when it actually comes to me offering or even speaking to somebody when it comes to actually having healthy credit, right? So one of the main factors that I always talk about is, what is your goal? What are you looking to do? What are you looking to achieve? What are you looking to buy, right? So obviously, given the fact that this seminar, it's about credit, it's also about money. It's about financing, where in this particular case, obviously Brent is going to go ahead and elaborate, talk a little bit about debt, assets, management, stuff like that. But we also have, in a sense, also mortgages, which is the ultimate goal, is the ultimate reality for people to go ahead and buy, right? So in reality, for me personally, obviously coming to this country, not having anything, going through different phases in my life where I've actually had an opportunity to have good credit, been able to obtain a mortgage or a home with my younger brother, going through the process of this recession, 2007, 2008. It obviously hit a lot of us. It impacted us in a way that, in that particular sense, people obviously stopped paying their mortgages, maybe lost their homes, stuff like that. And it gets to the point that you get and you think to yourself, how is it that I could actually get back? How could I get back into having healthy credit? That's kind of one of the things that I actually went through a process of learning. So before I obviously worked on this business, which is obviously Buildworth Strategies, I've actually had Buildworth Strategies for the last 4 years, I've also been an owner of another company called Redemption Credit for the last 2 years prior to that. And also I was a business banker for 6 years for Bank of America. Did a lot of financing through that aspect. And also I did mortgages as well for 6 years. So I've been literally in the realm for the last 15 years into credit. So through that whole process, I've been able to help out a lot of people. And this is basically the reason what I wanted to go ahead and talk about, which is going to be two things, is the rules and regulations as to what governs credit. How is credit, how are the capabilities for us actually to be able to have that? So one of the things that we have is actually what's called the Fair Credit Reporting Act. So the Fair Credit Reporting Act was actually enacted back in August 26, in 1970, right? So this act states that everything has to be accurate, verifiable, and complete. And if it's not, then the information has to be deleted or it has to be corrected. So in reality, the legal loophole that us as consumers that we have to be successful in challenging something on your credit report and being able to delete it or correct it is using these rules and regulations. At the same time, there's a total of 9 different acts that govern credit that have been passed to protect us. One of them, as a matter of fact, is called the Fair Debt Collections Practice Act, which again was initiated back in 1970. And this actually regulates how collectors, how information is being reported, who could report information, what information they have to go ahead and send over to us, the information they're supposed to go ahead and collect. So with regards to the rules and regulations, that's the legal loophole that everybody has as a consumer to be able to challenge the information and possibly go ahead and delete it. So through the process that we created in this business or an organization through Buildworth Strategies is through a dispute process. So obviously by sending out letters to the agencies, not only that, guys, we have to take into consideration that when we dispute something, we don't only have to go straight to the bureaus. So one of the things that differentiates us as an organization or as a business is that we've actually looked out to other things, such as the Consumer Financial Bureau Protection, which is another enforcer that actually protects us consumers to enforce the dispute process to the bureaus. We also focus on disputing with the creditors, which is also really, really important. And we have other avenues such as the FTC, which is the Federal Trade Commission, and also the State Attorney General's Office. So focusing on all these little rules and regulations is how us as a business are able to go ahead and help clients to restore their credit. Now really thinking about it, it's not only about disputing or correcting information, it's also about helping clients to rebuild new lines of credits. So one of the things that we've done at Buildworth Strategies is that we've created a 3-phase process, right? And the first phase of the program is where we help clients to restore their credit. So now thinking about what the formula of credit is comprised of 5 different tiers, 5 different areas, right? And this is actually what's called a FICO platform. The FICO is the Fair Isaac Corporation. This corporation was established back in 1956 by 2 individuals, which we have Fair and we have Isaac, right? So these 2 mathematical geniuses from MIT, they created this platform that now it gives us, it gives creditors a sense of what type of risk am I going to be running with this consumer. So in a sense, these 5 tiers play a key role. So now what are they? So the first phase, which focuses on the main area that builds credit, it's actually payment history. Through the payment history aspect of it, this includes anything like such as a late payment of a 30, a 60, a 90, a collection, foreclosure, bankruptcy, repo. It doesn't even matter. Everything in your credit, including public records, inquiries, can be challenged or disputed. So again, using the rules and regulations, what we want to do is dispute the information and remove it. What happens when you remove negative information? Your credit scores go up, right? We also have a second phase of our program, which is the rebuilding part. Through the rebuilding part, we're going to focus on the second biggest portion that actually builds credit, which is actually based on what's called the debt ratio. This is actually calculated through one type of account, which is actually the credit card. The credit card actually plays the second biggest role compared to not having any negative information. And what separates everybody from having good to excellent credit is the limits on your credit cards versus your balances. So it's in our best interest as consumers, because it's our best interest to be constantly replenishing, having an increase on our credit cards, and obviously maintaining below 30%. So the magic number here is always 30. Every time that you go above 30% on a credit card alone, your scores naturally start decreasing. So this focuses the magic number obviously being 30. So we have what is limits versus balances. So as an example, we have a limit of 1,000 and we have a balance of 300. 300 into 1,000 is that 30%. As soon as you start going below 30%, then obviously your scores are going to start decreasing, right? So the objective here is always try to maintain your credit cards below 30%. What is that going to do? Obviously, when it comes to lending, when you're about to go ahead and apply for a mortgage loan, when you're about to apply for a car loan, when you're going to go ahead and apply even for an upgrade on a credit card, when you're about to go ahead and try to reduce the interest rate on your existing credit card, the best alternative there would obviously be try to lower your credit cards as much as possible before applying for that. Now, let's go ahead and finish this off. I have a few more little circles here. With 15% of your credit, this is actually based on history. How long have you had credit for? So a good healthy amount of credit to have lengthwise is anywhere from 9 to 11 years. So how do we get this? If in this particular case,
Gotta be old.
you either have to be old or you have to go through a process or you just have to wait, right? But the best way to go ahead and get that is, let's say as an example, obviously I have a friend, right? I have a buddy downstairs, or my brother in this particular case, and I'm like, hey, you know what? I actually have bad credit. I'm trying to get good credit now. I know that you've had a couple of credit cards for 5-6 years. Do you mind if I go ahead and use your credit? He could literally go ahead and contact the bank and obviously let them know, I want to go ahead and add this individual. It could be anybody, so you're not really limited to the type of individuals that it is. It could be your cousin, your friend. Nevertheless, once you add that person over to the report, then that information will come onto the other person's credit report, and then you could also go ahead and capture that amount of time. So in that particular case, one of the best ways to go about that obviously is just adding yourself as an authorized user or go the long route, which is just waiting. Now we have an additional 10%, and this is actually based on inquiries. Just to ask, at least in this particular case, obviously given the fact that I was talking to somebody right now, as a matter of fact, we did a video just today on inquiries, and some people always call me up, and obviously the importance of inquiries to an extent is really to let the lenders and the creditors know the type of risk you're running. So in a sense, this whole platform allows that, or it allows a lender to understand exactly the type of risk they're running. But nevertheless, inquiries actually play a key role. So there's going to be two types of inquiries. We have a soft pull and we have a hard pull. So obviously based on the video, we usually have people that usually call me, Huto, listen, I'm at Macy's and I want to go ahead and apply for this credit card. They're going to give me this 15% off, and do you think I should apply? And usually my answer is, do you know what your credit scores are? And if they don't, obviously you're running a risk of acquiring another inquiry. So the best thing to do, one of the solutions that I always tell people, especially for everybody out here, if you're looking to have healthy credit, I highly encourage everybody to have a credit monitoring platform. Have somewhere where you're able to go ahead and log in, see exactly what's happening with your credit on a month-to-month basis. Because it doesn't make sense for us to try to get to the point of trying to have healthy credit or to get to that level and then not have a way of actually seeing what's happening. You could literally, you go through situations, maybe you go 2-3 months, and then an opportunity presents itself, you try to apply, and you didn't know a collection was on your report. So nevertheless, because of that, inquiries is one of those things that I'm going to highly encourage you guys. I have some information on how you can monitor your credit. There's a couple of companies that offer it, such as privacyguard.com, creditchecktotal, myfico.com, so that this way you could go ahead and avoid that. So a healthy amount of inquiries to have. Try not to have more than 6 to 8 inquiries in the last 2 years. And now, nevertheless, this is the beautiful thing about inquiries. One of the only benefits, that inquiries is the only account that falls off by itself. So you could literally wait 2 years, and then that account would automatically fall right off your report. And the last 10%, which is obviously gives us the whole full 100% of credit, this is actually based on mixture of credit. And this falls into 3 categories. We actually have one category, which is mortgages. We have installment accounts, and we have revolving accounts. So with regards to the mortgages aspect of it, obviously that's a home loan, which is obviously what we're going to go ahead and try to obviously give you more information on. Nevertheless, if you also inquire, if you do have an installment account, such as an auto loan, a student loan, that'll fall into that category. And we also have revolving, which obviously falls into credit cards. So that in reality, guys, part of the three-phase process that we have, which is the last phase of the program, which in this particular case is the education. So through the education aspect of credit, in reality, I think it's one of the most fundamentals. In reality, I think the best client for us, or the best client in general, or the best student of credit becomes the best person who normally achieves that score to an extent, because you understand how that score works, how your credit works, right? So for me, in this particular case, this is some information obviously on credit. I don't know if anybody has any questions.
Is it a good idea to keep your credit card limit, not a limit, but balance?
To keep a balance on your credit cards to zero? You could keep them up at zero. One thing that I always encourage people to do and have some sort of small balance on the credit card, because what happens is that credit, it's a snapshot on what's going on right now. So in a sense, if you have a credit card and you don't use it at all, it could get to the point not only that the creditor could go ahead and close it, but it could diminish the scores because there's no utilization on it. So if you have something, maybe it is a credit card that you could go ahead and maybe add a small recurring utility bill, go ahead and do that at least, and set up the automatic payment. This way, the more continually you have, the more prone you are for them to not only give you a line increase, but at the same time, it could continue to give you positive scores.
If you had, let's say you had 3 or 4 credit cards and you end up paying most of those off, and now you have one that you're really using, does it make sense to close the other 3 and keep one, or just keep them open and in a drawer locked up?
Well, I get that question a lot. Sometimes, especially through the credit repair process, we'll usually have people that start off, they don't have any credit cards at all. So the credit cards that I usually recommend for those individuals are going to be starter credit cards, such as secure credit cards. There's credit cards, one of them in particular, which is a bank, Credit One Bank. You might have heard of it, First Premier, First Progress. Those type of credit cards really come with high interest rates. It comes with annual fees. It comes with monthly service fees, withdrawal fees. So in a sense, I always say they're piece of crap credit cards. But you're going to get to the point when you're establishing credit and getting back to that point that you could get to the point of having healthy credit, and now you're applying for good credit cards, the ones that are giving you cash back, lower percentage of interest. It might give you some sort of balance transfer for 18 months, those type of things. So before closing out the credit cards that are not giving you any type of value, try to optimize the ones you have before letting those go. So in that particular case, you don't lose any kind of score. Yes, in this particular case, you could lose history, because let's say if that was one of the cards that you first started 3-4 years ago, and now you just acquired a few new ones now over the year or so, you're going to lose history, and you could also lose that availability. But nevertheless, you always got to seek the ones that do give you the best interest rates and some sort of rewards for them.
The opposite.
So I hope that answers that question. I wanted to go ahead and introduce the next speaker, my friend, one and only financial advisor, Brambo.
Good job for Justo. One more round of applause. Awesome. So how's everybody doing?
Unbelievable.
Good. That's great. So I want to thank Justo and Alberto with Buildworth Strategies. We've formed a partnership. One of the things that we both have in common, as you can see Justo up here, he has a big passion to help people and educate people. So we're the same on this side. We really have a passion to educate people and help people, just because how much empowerment do you receive when you're educated on something, right? If you're not educated on something, you tend to be scared. You've heard of the term fear of the unknown, right? So if you bring education to people, they're just going to be more knowledgeable and more likely to make good decisions around credit, around debt, around their finances. So we're going to, I also want to thank you guys before I begin, because you could have been anywhere here on a Friday night. I know that the Flanagan's is down the road, and it's it's like happy hour, so we'll be done here shortly. So it just lets us know you're very supportive for what we're up to, and you're serious to be here on a Friday night. So I acknowledge you guys all for being here. So what we're going to do is we're going to talk briefly on the fun topic of money. Okay, so it's crazy because money tends to be, taboo. Nobody wants to talk about it. Oh my God, you can't share about how much a person makes or you know, what that person's financial situation is. So one of our goals is to actually bring that all out into the light, because we don't learn money in school, right? What do we learn in school? English, math, history, science, and then English, and then girls, right? So, right. And then we get our careers. We get our careers, and then we're supposed to manage our money. But we never learned how to manage the money. I was actually in career day today with my daughter's 8-year-olds. I got practice for tonight with career day today. So I was practicing, you know, I was speaking with a bunch of 7 and 8-year-olds, and it's true. When do kids learn about money, right? So what we're going to do is we're going to talk about money, but there's really 2 facets of money. And I'm going to cover both areas. The psychological aspect of money, and then we're going to talk about the logical aspects of money. Okay? There's all this logical information about money, and I'm going to cover that at the end. But before we get into the logical, we got to deal with the psychological. What do I mean by psychological? All of us have some sort of perception of how money works or what it is. Okay, growing up, I grew up down south, Westchester, moved up to Pembroke Pines, but I grew up without no money. You know, I mean, I grew up regular. My parents were broke, grandparents were broke. I was going to be broke like them. Right? Unless I learned something new. So I had the blessing to get introduced to a company that was able to teach me about the fundamentals of money. Because if I didn't learn about money, I was going to end up being like everybody else, right? So if you don't do something new, you're going to end up like everybody else. So I ended up learning all these fundamentals of money, but then I started learning the psychological aspects of money. What do I mean by that? One of the things I used to hear my mom and dad say all the time were, if we wanted to buy something, and I didn't realize this till later in life, but they'd always say, put it on the card. Just put it on the card. I remember one day like Burdines was there, and JCPenney was there, and I go, she's like, right? I go, well, what's the deal? It's the same price for the clothes, but she had a JCPenney credit card and not a Burdines run, right? Like, I mean, these kind of problems we have, but you guys get me, right? So my mom passed away not too long ago, and she died with tens of thousands of dollars of credit card debt. So it's real, you know, and now student loans. You know anybody that has student loans nowadays? Everybody. Right? Hundreds of thousands, right? Hundreds of thousands. I was talking to a guy last night, 180,000. The largest one I've seen so far is 700,000. Wow. A pharmacist. This didn't exist before, okay? So let's cover, so if I heard my mom say, put it on the card and put it on the card, guess what I did? Put it on the card. Right? So let's go over we're gonna do a little exercise here. What are some of the things that we all know? Okay? So I need you to fill in the blanks. All right, you all in the back, I need you to fill in the blanks. Money doesn't grow on trees. How the hell y'all know that? It's like automatic, right? Right? Because we heard that thing. How many times do we hear that? Mom, I want that. No, we can't afford it. Okay? Money's the root of all evil.
The love of money.
For the love of money. My boy's studying over here, right?
He reads.
And money doesn't grow on trees. Well, what the hell's money made of? Paper. Right? It actually is, right? How about this one? This is one of my favorite ones. I don't know where you grew up, but if you grew up in South Florida at some point in time and you're like maybe 17, 18, and you see a young 21-year-old driving down the street with a nice car, and how the hell do you afford that car? You must be a drug dealer. Y'all know this stuff, man. So these are all stuff. Here's the deal. What happens to most people, 90% of the people that win the lottery? They're broke within a couple years. So you could get anybody the greatest financial plan in the world, but if you're stuck with still these psychological aspects in your brain, you're going to lose it all. Just like how many people have you gotten out of credit and 6 months later they're back in your office, bro. You know, so
that's why the education is important.
So that goes back to your question, or I think it was Chuck's question, do they cut it up or not? Well, it depends. What's your psychological situation? If you have a loaded credit card gun, it's sitting in your whatever, you keep it, right? You're gonna probably slice it and dice it again. Okay? So we gotta kind of look at these psychological things that we're all dealing with. There's a story of a lady in our office that very successful CEO, made all of these, hundreds of thousands of dollars, and she was going bankrupt. She lost her house, she did it again, and then she got some psychological help. And this person who knows how to do this wasn't me, I'm not trained in that yet, I would like to learn how to do this, but this person, like a therapist, met with this young lady and started asking her questions, and he took her back to when she was 5 years old. So this 5-year-old little girl, her tia asked her to go help her move some furniture at the house. So she went, started moving furniture, and her aunt goes, okay, here's some money. She was all jacked up, she had some money, and guess what? She went back to her house, Mommy, I got some money for helping Tia. What did you do? How come you took that money? You should have never taken that money. Go give it back to her. And the girl freaked out, scarred, right there. Guess what? Every time she got money in the future, guess what she did with it?
You give it back.
Hot potato, man. She got rid of it. Tax returns. People get their tax returns. I got $8 grand. I got you know what I mean? But think about it. Maybe some of y'all, I'm all guilty of it, right? So we got to start taking a look. We got to start looking at. Right, tax season now, so everybody's like, some of y'all just did that, right? So I don't know the answers to all this stuff. But isn't it make sense to pay attention and start looking at this stuff? What's our relationship to money from a psychological standpoint? Okay? So what's happening in the industry is, let's look at the credit card industry. Does the credit card industry want you to be in debt or out of debt? In debt. 10 years ago, there was a statistic. If a family had one credit card, they had an $8,000 balance. 10 years later, it's doubled to $16,000. Right now, student loans are being garnished by the IRS. Seniors are in retirement. I'm retiring, but Social Security is getting garnished. Tax returns are getting garnished. Bank accounts are getting garnished for crap from years ago. Okay? So the debt industry wants you in debt. The banks want to give you low savings rates, right? What's the savings rates at the banks these days?
0.02
something garbage, right?
Yeah, point something.
So let's take a look at every bank, because there are banks popping up everywhere. Look, I'm looking at Eastern National Bank. Who banks there? Not one person, but they're taking somebody's money, right? These banks are everywhere. So let's look at banks. All-time debt at this high, right? And all-time savings rates this low. Who's that working out for? Is that helping anybody out?
The banks.
The banks, right? The wealthy people know this information. So what we want to do is meet with people and help them eliminate their debt and start using those dollars and getting better rates of return, like 6, 7, 8, 9% over long term. So then one day they can retire. Okay? So who would like to retire one day? All right? I don't want to retire. I can't retire. I'm going to work forever. All right, slow down, okay? Maybe work because you want to, not because you have to. All right?
I like that concept.
Okay, right? I get that. Oh, when would you like to retire? So I've dealt with this one a few times, right? But here's the deal. What's the old way of retiring? You know what's the original way of retirement? Who wants to take a guess?
Waiting for Social
Moving
Security.
with your kids.
Pension.
Before that.
Before that,
Man.
It was a farm.
you had like 20 cows and you would live
You
off the
inherit your mom's
milk.
farm. You inherit your parents' farm.
Yeah.
Okay? So this is what happened. So I'm going to take you back in history, and then we're going to go to the present. Imagine there was nothing in the United States. There was nothing but farms. Okay? You just took over your parents. You just kept doing it, right? But then what happened is the Industrial Revolution happened, and the cities popped up. So here comes these CEOs and these big companies. They go, dude, do you really want to be in the farm for the rest of your life? Come work with me in New York. Come work with me in Chicago. Come work with me in all of these places. And by the time you're 65, I got you. I'm going to give you a check for the rest of your life. And that's where the pensions got started. And then the government also said, oh, don't worry about it. Work, and by 62, we're going to give you another check. So behind the scenes, though, they're like, dude, imagine this is the 1920s and stuff like that. They're like, these guys are going to die by the time they're 50. We don't got to pay them shit. Right? But guess what happened? People start living because of technology and health. There's some guy in General Electric that retired at 50 and he's 120 and he's still collecting right now. John's like, bro, when's this guy going to die? You know what I'm saying? So what happened is they started getting rid of pensions, and this is a true story. In 1981, 1970, everybody heard of a 401k? Yeah. Right? We all heard of that. But who has a pension in here? Nobody, right? So everybody used to have a pension. Nobody had a 401k. And in 1981, these business owners that knew the people in the tax code or whatever, they had all of this extra cash, all of this extra money, and they said they're going to get taxed on all these profits that business had. So they said, you know what, we got to do something with it. All of a sudden, a 401k came about they were able to put this money into a 401k and then not get taxed on it. So they went, interesting. This pension's costing me so much money, and we have to pay these guys out of our pockets. I don't think this is a good idea. So no 401ks, and pensions were up here. All of a sudden, they started getting rid of pensions, little by little, where the corporation was helping people, and now they started making the responsibility from the corporation. Now it's your job to invest in a 401k. But nobody else knows how to use a 401k. So little by little, who's heard the rumors of Social Security, right? That it may not be there. My dad is about to retire. He's made whatever. Let's say he's made $100 grand. Didn't save a dime, over the time. It's the truth. If he was here, I've said this story in front of him, so I'm not trying to. But it's the truth. He never learned this stuff. I wish he would have learned this stuff growing up, right? That was not his fault. Nobody educated him, right? But imagine he made $100 grand the last 5 years, right? His Social Security check's going to be, that's $8 grand a month. His Social Security check's going to be $2,000 a month. You can't live on $100 grand a year. How are you going to live on $24,000 a year? It's not going to happen, right? So that's why it's very important to get out of debt and save for retirement, okay? So there's 4 scenarios that we're all going to end up. So are we cool with the psychological? You all going to start paying attention to that stuff? Okay, I don't have a course on that. Maybe one day we will, but I just want you to start looking at it, okay? So we're all going to end up in one of 4 situations when it comes to debt and money, okay? This is all of us are going to end up in one of these scenarios, okay? First scenario number 1. Now, there's only one ideal scenario, okay? And this is at retirement, okay? So let's say at retirement, you're ready to want to, this is you're in your whatever age, you want to just, start vacationing and relaxing. But unfortunately, you have a lot of debt, but you also have a lot of money. So all your money is going to pay your bills. Not a good situation. The other situation is you have 0 debt, but you have 0 money. Also not a good situation.
Still broke.
Still broke. The worst would be a lot of debt and no money. This is when I really have to, these are scenarios when I sit down with somebody who's 60 or 65 and they say, I don't want to work anymore, and I'm saying, you got to keep working. It sucks to tell somebody that's ready to stop working. Teachers, when they retire, right, they get half of what they were making. Teachers can't live on 100, imagine half.
Right.
So they got to keep working. But what's the ideal situation? It's obvious.
0 debt.
Who would like to end up in this situation? Everybody. But where was this taught in schools, man?
Never.
Right? One of the challenges, like I said, is the industry wants to get people in debt. They don't want to get people out of debt. They want to get people low savings, not high savings. And the investment companies out there, the big ones, do they want to talk this? They want to come and give a speak with the average middle class person to no. These big financial institutions, they won't sit down with you unless you have $250,000, $500,000 in investment. Who has 250? Like 1% of the population, 5% of the population. All right, so
More than that.
I'm going to finish with this last little piece, okay? And what we're going to do is I'm going to show you a basic financial plan, okay? So now we're talking about the logical. We're going to finish with the logical, okay? So what does a strong financial game plan look like, okay? Now it's different for everybody depending on where you are on your path, but it kind of looks like this. Everybody falls to somewhere in this place. So we're going to call this a financial plan, or we're going to call it a financial house, okay? Financial house. All right, so like a regular house, imagine you were going to build your dream home. You've heard people that build their dream homes, but they don't build it like overnight, right? Maybe they get the land and they build it little by little as they afford it. So the same goes with a financial house. You will build it layer by layer, bit by bit. So what's the strongest part of any house? The foundation, okay? So what is a foundation in a financial house?
Your savings.
It can be, it should be, ideally, and then eventually, but where does the savings come from? People making money, right? Okay, so the income of the breadwinners, okay, even if you're a stay-at-home mom taking care of the kids, there's an article that stay-at-home moms are worth like $100 grand a year. Okay, today's Women's Day or something like that. All right, so income
Every day.
every day, right? That's true.
Every day.
This guy's shocked, man. All right. So the foundation is an income, but what happens, God forbid, one or both of the parents die or pass away? What happens to the foundation? Collapse, okay? So that's why, one, any strong financial game plan needs to have life insurance in place. And life insurance is a very misunderstood product. People think it's expensive, people think it's supposed to have a savings plan with it, and it's actually a very inexpensive plan, but it's something very responsible to own. Would you agree with me there?
Yep.
And most people don't own it because they've never been educated on it. A person in their 30s or 40s could get a life insurance policy for $30 or $40 a month. People are going to go here to Flanagan site and spend, how much did we spend, Elias? Where was Elias? We just spent $40, right? So, on food. We'll be gone tomorrow. You know what I'm saying? We spend money on so many things that's not an asset, right? Okay? So life insurance, most Americans don't have life insurance, or they have it through their job, which is also a waste because you don't own it at your job, okay? Or if you have a life insurance policy with a savings plan, you're spending a lot of money. So never depend on life insurance at your job, and if you have a life insurance plan with a savings vehicle, you're getting ripped off, okay? The next thing is you put up the walls and you put on the roof. This is what we call a legal plan. Making sure that parents have their will, living will, and all their legal stuff. Because if you don't have your legal documents in order and your parents, and you don't have it in writing, guess who's going to take over? The state. Now, would you want to have your orders in writing, or do you want the state to make decisions on that? Craziness. Because if both parents pass away, guess what? Anybody from the family says, I want to take care of him. No, I want to take care of him. I want to take care of him. Shh, the state goes, give me the kids. We'll assign them to whoever we think. Right? So there's a way to get rid of that. Okay? So that's the protection. So this is the protection, and this is protection. The inside of any financial game plan is the decorations. Okay? This is your savings. This is 2, 3, and 4. This one is what we call a short-term account. I use the word short-term because I like positive words. I don't like rainy day fund, or I don't like emergency account. Why am I going to set up an emergency account? Oh, it's coming, right? No, I don't want that. Short-term account, okay?
Sounds better.
What's that? I know, but I get that. We could talk after, but we got to change our language because, you know what I'm saying? Seriously, yeah. That's the psychological. We just talked about it. Thank you for, I appreciate it. So you ever heard of having 6 months of your expenses put away?
Yes.
No.
So one of the things I teach people is when they get this check from the IRS, breathe for like 5 minutes, right? Like maybe you put half in your short-term account, and the rest pay off the debt, or if you want to go on vacation. But like, make a decision, because if you have 6 months of your expenses,
Of bills, right?
6 months of your bills put away, and you lose your job, your roof breaks, you need new tires, a kid goes to the hospital, God only knows all of these short-term incidents that we can have, right? You could pull from here, because guess what? If you could pull from here, do you have to use your credit card?
No.
No. Okay, so this is a defense mechanism against your credit cards. Number 3 is retirement. We just talked about retirement. So we know Social Security, pension plans are not going to be there. So we got to save for our future. Because really, the only way we're going to be able to live if we save up enough money. So there's 2 retirement plans that the government allows us to use. One is through your job. Most popular, we just said it, is a 401k. Okay? So if you have one over there, you definitely want to use it. They match you. The investments are what are called mutual funds. There's no way around it. Mutual funds are all over. That's the default mechanism of that. But you can also own a personal one, which is called an IRA, or individual retirement account. Now, guess what? If you open up an IRA at the bank, guess what the interest rate is?
0.
Yeah,
Point
whatever,
whatever,
1%.
Half
But
or something.
these 2 things. Now, guess why most people don't own these is very simple. The most you can put in a 401k a year is $18,000. And the most you can put in an IRA now is $6,000. Are these big investment companies that only take $250,000 or $500,000 to open up accounts, are they motivated to go do this? No. That's why most people don't own them, especially in the middle class. It's because the investment advisors are not motivated to do it. Yet if most Americans didn't even do the max, if they just did 5% of their paycheck here and another $100 a month or $25 a month there just to create a good habit, right? Imagine saving every month. Who's heard the term pay yourself first? Right? We pay this guy and that guy and this guy and that guy and this bill and that bill, but when are we going to treat ourselves like a bill? What if you treated yourself like a bill and you paid yourself every month, automatic? You create a good habit and then you can increase it, right? So we want to make sure that people are taking advantage of those two things. And then with college planning, we actually have control now of these future loans. You want your kid to have 100 grand in student loans in the future? No. I just had one of my buddies who I started off with $50 a month. I was at his house. He did it maybe like in 2007, and we started with $50 a month, and he increased it. And I was at his house, and when I come over, my child's 16, he's about to go to college, and we need to evaluate everything. And I'm like, all right, let's sit down. I was like, oh crap, we're going to evaluate. I'm like, I hope there's enough there, right? And we did the math. He has everything. He has almost 40 grand in there now. And he's going to get a couple scholarships, whatever. But the kid's college is paid. Starting at $50 a month. I was like, thank God this crap works. You know what I'm saying? But it was cool. You know, it was really fun to see that work, you know? And he was like one of my first appointments, too, ever. Where I didn't know what was going on. I brought my trainer, and I was like, what's going on here, you know? And then it worked out. And then last but not least is you know, Justo's Buildworth Strategies crusade is debt. We want to make sure we help people get out of debt. And that's where Buildworth Strategies and us work together. They do stuff that we don't do, and we do stuff that they don't do. Their clients need us, our clients need them. When there's a credit question or any type of a challenge when it comes to that, I say, I don't know, but they do. And when it comes to all these other areas, they go, you know, they don't know, but we do. And that's a collaboration that's going on. Because if we can help people, that's some smoke, right? Smoke away their debt, and that's a chimney, right? All those dollars that they were spending, does debt cause psychological pain?
Yes.
Right?
Perfect timing.
The speaker doesn't like that either. They want to say too. But we want to. What's it sound like? There you go.
It's an alarm.
That was perfect. Somebody has a remote control. What we want to do is help people have a game plan to get off that debt, because if people can begin to pay off their debt and pay it off for good, what can they use those dollars for? Their financial future. You can't. How are you going to have a financial future of investments if all your money's going to debt? So this is, for many of you, if I haven't had a chance to meet you yet, nice to meet you. This is for most people the first financial class they've ever gotten. Isn't it simple to understand? Like, who's keeping this information from us? I don't know, that's another conspiracy theory conversation. But I'll be hanging out here for a while. We're here to help. We're going to do this in the future. I'll take a couple of questions. Bill, yes, sir.
Do you need a lot of money to start one of these investment plans, or how do you start?
Great question. Thank you for asking.
He says he has a lot of money.
Money, I don't know what to do with it.
So what I do, when I sit down with a family, I'll draw this out. And one of the rules, just in case any of you guys want any further, if I ever meet with somebody, I never do any transactions or open up any accounts on the first visit, unless it's like, Brant, come over, I need everything you got right now. But some people need more information, education. What I like to do is meet with people, give them the education, and then I ask them a simple question. If we could come up with a game plan for you, how much do you have per month that you could start something basic, right? And I say, look, it'd be great to build your whole financial house all at once, but that's not how it happens. We got to build layer by layer by layer by layer. So I've had clients that say, Brant, all I have is $50 a month. Great. I could figure out a life insurance policy for $25 a month, and we'll start your short term for $25. Or I got $100 a month. So it doesn't really matter. So the minimum investment that somebody can open up an investment account is actually $0. I'll open up the account with $0, and we set a date in the month, like on the 1st or the 15th or the 18th or the 28th, and it'll start coming out of their checking account every single month. Is that going to get them wealthy, $25 a month? No. Is it going to start working on their psychological habits? Yes. If you can save $25 a month, can you save $28 a month in the future? And I would just tell people, increase it. It doesn't even matter. So to answer your question, $25 a month is how everybody can begin. And then what I do is we meet with everybody once a year, because things change. People have kids, they get into debt, they get out of debt, they leave their jobs, they buy houses. So we are, on call People need to meet again because our clients are our clients for life. You know, and the ultimate goal is that we're able to get them completely out of debt, have their money put away, so one day when they turn 60 or 65, that they have enough money to retire. And how we do that is very simple. At what age would you like to retire? 65, 60. At 50, if you're, you know, if you're really, you know, motivated. And we just say, what type of income would you like to have? So people will say, oh, here's the question. If your kids are grown, ask this to yourself. If my kids were grown and my house was paid off, what would be an annual income that would give me a good lifestyle? Oh, people say 50, 100 grand a year. Imagine 100 grand a year, even 50 grand a year with no debt, no kids, 4 grand a month, good, right? But 20 years from now, 50 grand is not gonna buy anything. So you can pretty much every 20 years, stuff doubles because of inflation. Okay? So then I say, all right, you're gonna need about $1 million or $2 million by the time you retire. And we say, look, in order to have that saved, you need to save this amount per month. If you save this amount per month, you'll hit your goal. But usually people can't save that amount. And I go, that's okay. Start with whatever you can afford and increase it over time. Cool? All right, great. Thank you.